It's my pleasure to call this meeting to order pursuant to Section 21-1503 of the Philadelphia Code. We will be recording. The recording will be available to the public online on the Sinking Fund website within 10 days. If you're joining the meeting, you are consenting to the recording, and your login, email, phone number may be part of the recording and made available to the public. I hope everyone understands that. The first item on the agenda is the approval of the commission's transcript for the January meeting. Is there a motion to approve?
I'll make the motion, Don, to approve the minutes.
Is there a second?
Second.
A motion has been made and properly seconded. All those in favor, please say aye.
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 The ayes
Was not
have
at the last meeting.
At this point, I'd like to turn the meeting over to Christopher for comments.
Thanks, Don. Just briefly, I just wanted to note, as of this morning, there is just under 643 million in total assets in the fund. That includes 7.98 million in cash, which is close to 3 months benefit payments. And with that, you should be able to see the returns for February up on your screen. I'll turn it over to Floyd and Alex to walk through the manager commentary and any market commentary.
Yeah, thanks. Today should be a very interesting day with the Fed meeting. Hopefully we'll get some good expose that will provide some direction for the coming months. So with that, I'll turn it over to you, Floyd.
Hi, everybody. For the Fed portion, I think, if you look at the markets have kind of came into this year saying 6, now realizing it's going to be 3. Again, one of my comments from an earlier meeting has been, if the Fed doesn't want to be political, why would it say it's going to do 6 rate cuts in a year when it usually tries to do a minimal amount of rate cuts during an election year? So 3 seems to be the number as of right now. People are waiting with a bated breath to kind of hear the Fed talk and speak. I think it'll still be the same things are going to be the same things. Worry about, inflation, especially the core inflation portion, that being still high and stubborn. I think, you've heard us mention, hey, going from, a high of 8% down to 5, that's one thing. Going from 5 to 4, that's another. Going from 4 to 2 is the real hard work, and you're starting to see the hard work. And really more if you look at inflation, you start to see it essentially, quote unquote, table out. So that drop is less and less and less within there. Why? Because the components are a lot harder. If you're going at it on a daily basis, how do people on a daily basis judge inflation? They look at it by their food portion. How much are you paying for your groceries? That's been increased. Also, you'll notice from your insurance. I'm pretty sure all of us, whether we have a car or a house, depending on where we are in the United States, our insurance is either a little bit more or significantly more. So you're seeing that also play a part in, quote unquote, how people view and think about inflation as a whole. Is it better than last year? Yes. Is it still higher than normal? Yes. Does the Fed still have the target of 2%? Yes. More, but the question is, will the Fed actually be able to meet that 2%? Because remember, if you take this time period before, they could not hit 2% for the longest. And so while it might be an aspirational goal, the reality and aspiration might not be right there. Also internationally, I would go out and point out a couple things. Just like we're going through an election period, you have a lot of the other major countries going through election period. So you're going to know it's going to be a lot more volatility within the market. You're seeing that within the flows. If you think about it from a year-to-date time period, year started off really hot for domestic. You'll notice that it was definitely all about AI, and it's kind of broadened from there. You also see that internationally, where you have noticed that it's been one of the themes of AI pushed by Japan. China has not done well. If you've noticed over the past, let's say, month, it's been a little bit of a switch domestically. yield slash value stocks have started to do a little bit better. Internationally, you'll notice that China starts to do a lot better. So you've started to see people move a little bit of money around within there. And then last but not least, just thinking about fixed income as a whole. Fixed income, it's always been played, if you're looking at it from a duration aspect, you want to be shorter on the curve. I think the more you see more people go out longer. You've seen it this year, even with the flows. A lot more people going into a longer duration, whether it's ag bond, intermediate as opposed to being in short, or it's going into some other type of long treasury fund. So you have been seeing that within the market. So people are preparing for us to basically say it's peak rates. You're going to still have that soft landing. There's going to be a lot more volatility in the market. And if you're noticing the broadening of expectations, people are starting to get more and more closer to their strategic targets versus trying to be tactically overweight to certain areas. Alex, Chris, Fran, you guys have anything else that you like me to hit, focus on? Because I want to give you a good broad view of just the United States, the world, and bonds as a whole.
Yeah, I've got nothing really to add to that. Thank you very much, but I'll open it up to anyone else.
Christy, Don, Bill, anything before they go through the performance?
Nothing from me.
All right, Alex.
All right. So, with that, you can see the month here, the quarter. I think it's interesting to focus on year to date just because this is February. We have the first 2 months of the year in. Modest outperformance for the plan, net of fees, 278 versus 2.66. A lot of that coming in February. As you can see there, U.S. stocks up, 4 or 5% for the, in the month of February. January was relatively flat. So far in March, I think, markets have been a little more trepidatious. So a lot of this coming in February. Within the actives, I think Pine Bridge, again, you can see lagging slightly for the month. Their 1 year figure, 28.4 versus 30.45. A lot of that last year, they trailed slightly due to the, prominence of, the concentration in the S&P. I'm thinking of names like NVIDIA and Microsoft and others like, slight underweights here and there to those, high concentration names will impact them. I think Floyd alluded to this. We're expecting markets to broaden, particularly among certain, we might see a bit of a value shift here and there. We're leaning on active managers to navigate that. I don't think we're recommending, a wholesale shift of the portfolio, but we do expect markets to broaden. Another reason why I think earlier this year or late last year, we recommended getting, back closer to targets. Copeland, I think again, interestingly, a slight miss for the month. Higher very strong outperformance year to date. I think that, they're a little more rate sensitive when there was some volatility in January. I think they were the beneficiary. I know late last year, Copeland, along with the REITs, benefited quite a bit. So similar situation. Really nice to see within international equity, nice outperformance from the actives. They've navigated a challenging, geopolitical climate quite well. Fundamental stock pickers, I think, are the right strategies to employ right now in the international market. So, we're very pleased with that right there. I think we're on the next page now. Fixed income. So again, this was an interesting one for the month. I think year to date, generally, everything when it's rolled up is slightly ahead of benchmark. You've got some yield advantage from high yield. But most of the actives here, I wouldn't say, repositioning in the face of, the inflation news we received this year. So I think a lot of them maybe had been, positioned for growth in fixed income markets. As Floyd was alluding to, maybe more rate cuts than expected. I think most of the market was positioned that way entering this year. Generally you can see the results there resulting in slight misses for most of the actives. As I mentioned, Sky Harbor nicely contributing on an absolute basis, but also adding some relative value to over their benchmark this year. So that's another good sign. They've kind of pulled back over the last 1 year, almost to net of fees to right within their benchmark. So, and then at the end of the month, about 10 million in cash. We drew down on that again. No recommendations right now to raise. I think maybe Chris will speak at the end of the week or something following the comments today and look maybe to raise another month or two, but we'll wait till we have a little more clarity. But other than that, the near-term returns are looking quite strong. And then, over a longer period, I think actually, since inception for the total fund going back to 87, I think the plan now matches it looks like it is matching the benchmark net of fees. And that's, in excess of the actuarial rate. Now, that was the bottom of the market, there, I want to say, or close to it. But all in pretty nice picture. So that's all I've really got to say. I'll open it up to any other questions or comments.
I just had a quick question. This is John Sherman from Philadelphia Gas Works. I'm not as well versed as the rest of you probably in some of this, but how come the combined fixed is down compared to the rest? Is that just subject to more volatility?
Yeah. So when we were talking about there's market volatility and there's interest rate volatility. And if you think back to last year, right, even further back, like August, September, interest rates kind of shot up. Back then, inflation had not fallen as much as it had. There was expectation the Fed might continue raising rates through December of last year. Mortgage rates were up over 8%. And then as we got through to the end of the year, it became apparent that inflation was slowing and the Fed rate cuts were done. So rates on the open market fell. And when interest rates fall, when interest rates fall, bond prices increase. It's kind of counterintuitive, but it's an inverse relationship there because, you've got these existing bonds that are paying a higher yield than what is being issued right now. Since the end of the year, however, you've probably seen this in the news, the inflation, the rate of decline in inflation has stalled. Labor markets have been, it's interesting. Labor markets have weakened, but they've been beating expectations. So, that's been contributing in some result to, expectation. Maybe the Fed won't be cutting rates as quickly as we expected. And so that has led interest rates to go up on the margins. When rates go up, the prices of those bonds fall. So that it's just kind of, active trading in the bond markets. It's said, and as Floyd mentioned also, a lot of people are now kind of trading into long-term bonds. So we think maybe, at this point, we might be getting close to hitting peak interest rates. We're not really of the mindset of trying to time those types of trades. We make marginal trades or recommend such things, over the course of years based on fundamental data. So we're not really going to try to hit the market at the top here. All said and done, I think, Brendan, you've got bonds that are yielding a good amount. We do expect rates to fall. It might be over a longer period than people have expected. So we also see growth in the equity markets, especially over 1.5 years out and beyond. Now this is an election year, right? So there's a lot of volatility expected between now and, let's say, the end of the year. We think, historically, when you look back at periods when soft landings have been achieved, we're kind of in a similar landscape to like 94, 95. after which we saw, tech-driven market gains for like 3-4 years. And frankly, I think, the current tech hardware is, a lot better than like pets.com and stuff of the old days. So we're in an interesting inflection point. So I think, we're not ready to let's say load up on bond risk now. We think it's still worthwhile taking a little bit of equity risk. The portfolio, I think, is like 1.5 to 2 percentage points overweight to stocks. It's drifted up that way since the end of the year. We're okay with keeping that there, but and a good example, certainly that's benefited the portfolio as bonds
Right.
have been volatile. So yeah,
Hey,
long,
John.
long-winded response.
Hey, John, and just one thing to note, within bonds, the yield curve has shifted up a bit. So when you're seeing that negative, what Alex was alluding towards, as if a yield curve shifts up, then that's going to push prices down for bonds. And so that's essentially what happened. So you currently have a yield curve. If you take it out going past the 2-year number, out to 10-year, it's actually shifted up a little bit more over the past week and 1 month. So that's one of those reasons why you're starting to see negative returns within bonds from the price portion.
Okay, thank you. Thank you
No
very
problem.
much, both of you.
So that's about it. I don't know if there's any other comments or questions for us.
It appears that there are no additional questions. Christopher, do we have any new business that we need to discuss this morning?
I just wanted to, it'll take 1 minute, no more, just catch everyone up on the RFPs that are either soon to be posted or outstanding. The fixed income passive RFP that the commission authorized at a prior meeting closed. We received 2 responses. And myself and PFM will have a recommendation at the May 15th meeting for that opportunity. The general consultant RFP, due to statutory mandate, has been released. I'll keep the commission posted on timing for that. The auditor RFP will hopefully be up tomorrow. It's just undergoing a final check from the finance and contract folks. And then I'll start working on the custody bank RFP, which is also up later this year. I'm going to try to have those all done, at regularly scheduled meetings, but given the actuary meeting later in the year and a couple of other things, it's possible I may ask for a short special meeting in the summer or early fall just to deal with one of those RFPs. I will keep folks posted on that. That's all I had on the RFPs and new business, Don.
Thank you, Christopher.
Thank you.
Anything else before we adjourn? Is there a motion to adjourn, please?
I'll make the motion to adjourn.
Second? Well, so moved. Thank you. And
Thanks,
ladies,
everybody.
Thanks, everyone.
have a good one.
Thank
Yes.
you.
All right, thanks, everybody.
Thank
Take care.
you.